Welcome in Managerial Finance, Cash Flow and Financial Planning prepared by Dua Salman. In this video, we're going to look for the cash flow statement and other financial statements preparing for financial planning. So in the previous video, we started by the cash flow, and today we are going to recap the cash flow and the components and how we can prepare. Second item that we are going to look for the cash budget and how we can make a future planning for the cash budget, in addition to the PROFORMA income statement and PROFORMA balance sheet when you are estimating the future income and the future balance sheet. So as we remember that the cash flow is summarized in inflows and outflows. So if I buy assets, I buy assets, and this means I spend money. I buy assets, I spend money. This means that cash is outflow. If, let's say, for example, I sold the asset, the machine, the equipment so that I have it, so that I receive money in return to this in selling. In the opposite to the liability, if I took loans, that is inflow. If I pay the loans or the commitments or the liability, that means that I pay, then I give it back, then I spend, then it is outflow. Profit is inflow, losses outflow. As you see, depreciation, non-cash, and the dividends here, it is an outflow because you distribute the profit across the shareholders. If you buy assets, let's say, for example, we said if we buy assets, it is here an outflow. But here, if you repurchase these assets or these stocks in terms of wealth, this means that it is an outflow. But if I sell all the stocks, then it is an inflow. So let's see our financial statement, the cash flow statement, operating flows, investment flows, and financial flows that we have represented here in this given balance sheet. And we have balance sheets for 2 different years, and we are preparing the cash flow for the company ABC. So as you see here in this statement, you are going to watch the difference, calculate the difference between the 2 items. What are the 2 items which are very important for us? It is the one that we are looking for, the difference between cash between the 2 years. So the difference between the cash here and the cash here, it will be represented to the net cash here, net cash flow negative 0.75. If we go, for example, let's say if we proceed a little bit and proceed for another item, which is the operating activity, how the operating activities look like. So we are going to start by the net income that we receive it here. So the net income that you can see here, net income, it is given in the bottom of the balance sheet. So we start by the net income and then the depreciation. As well, if you look for the depreciation, which is can be also calculated if it is not given, it is the difference between the accumulated depreciation. This is will give me the 135. So you have 2 ways to calculate the depreciation. Either it is be given from the income statement or it is the difference between the accumulated depreciation. So what else we can go for? We can go for the operating activities, for operations. So we look for the account receivable. The account receivable was 139.5 and it increases 165.5. So if we do the differences, my assets increases. That means that this is a difference of 26 and it is an outflow of money. I didn't receive them yet. I didn't collect this money. So it is an outflow. If we go for the inventory as well, the inventory increases. I buy inventory, I have more inventory, so it is as well an outflow. So this is basically the 2 important points here that we can see from the current assets. Let's go for the current liability. What we have from the current liability, we have an accounts payable at 129.5 and 237.5. So if we go there and look at the difference between them, it will give me 8. So the accounts payable increases. So this will be in terms of 8, the difference in terms of 8. So it will be here an inflow. So when we add the components of the net income, depreciation, change in current assets, and the change in current liability, it will give me 164. So this is the first part, which is the cash flow from operating activity. So let's come for the second part, which is cash flow from investment. How can we find the cash flow from investment activity? So we have the gross fixed assets, which are the machines, the equipment, so the assets that we have it here. So if we go here up in the accounts payable, sorry, in the fixed assets, you have 1,690.5 and it become 1,845. So this means that I spend a lot of money. I have a lot of money, and this money is represented by the buying assets, and buying these assets will reflect more on items here, and will be my outflow. So I buy more assets, and this buying of assets, it will be for investing in the company. So I have only this type of assets or investment. I didn't buy any things in any subsidiary or anything. So it is just an investment in the machine. So this will give me the cash flow from the second part, from investment activity. And this is an outflow. So I spend too much. I receive money from the activity, but I spend too much here in the buying the assets. Let's go for how we can finance this. We're going to finance this. It is a change in notes payable. So we have a change in notes payable, and my notes payable here, it is a short-term notes payable. I'm financing them. So if we go for the short terms, it is 63 and then 54. So the differences between them will give me, the difference between them will give me the items of the notes payable. It will give me the item of the notes, change in the notes payable. So after we did the notes payable, which is the difference between 63 and 54, then we are in need to look for, this is the notes payable. That's it, which is -9 because I pay back the notes payable. If I go for the long-term debts, which is 60, how I got the 60, which is the difference between 720 the previous year and this year had become 780. So I receive around 60,000 or 60 million K or inflow of money by 60 to finance this investment. Left for me the dividends, because here we have the change in return earnings. So you know before that when we calculate the dividends, we take the 200 money, the change of the returned earnings. This would be the 40.25. So we have 200, and this 200 money, the change of the returned earnings, will give me the dividends. So when we add the three items here together, the notes payable and the long-term debts and the dividends, this is long-term debts and the notes payable and the dividends, will give me the cash flow from financing. So when we add the three items, what are the three items? When we add the cash flow from operating, and then the cash flow from investment, and then the cash flow from the financing, the three items will give me minus 0.75. How can I be sure? It is reflecting the differences between the 96.5 and 95.75. So this is correct, and I did it in a proper way. So this is how you can make sure that your cash flow statements are correct. So this is the first item, or this is the first part where we can find all items related to the cash flow statements. After we did the cash flow statements, we are in need to go for the second financial planning statements, and will lead us to the long-term strategic financial plans, which may take 2 to 10 years, and it needs a lot of uncertainty and planning and accuracy, and it will be guidance for the company if we have an excess of cash or required to finance. So to look for the long-term financial planning, we need to look for the investment in the assets and development, marketing, the capital structure that we have it, debt or equity, and the source of finance to support my budget and my profit. So we're going to do by the short operating financial statement, which can take 1 year or 2 years for operating. So it is need a lot of actual forecasting, and this is what represented by the cash budget. So as you see here, this is the balance sheet, and this balance sheet, current period balance sheet, it can give me the PROFORMA balance sheets. But if I have sales and I have a production planning, will reflect on my PROFORMA income statement. And this PROFORMA income statement will reflect on the cash budget. Either here we have an excess of cash or required to finance. If I have a required to finance, I need to ask for more money. If I have an excess of cash, this means I can spend it in fixed assets and other item like this. So the short-term financial planning begins with the sales forecast and my estimation for the coming year forecasting and how can I reach the sales in the coming year. The production plans are needed to provide raw material, production, labor, factory. So this will reflect on the production plans and it will reflect on the cash budget if I have enough cash or not. If I have enough cash, and this cash will be also depending on the PROFORMA income statement and balance sheet. So let's see the cash budget, the second statement. The second statement here, you will look for the short-term cash requirements. Either you have surplus, excess of money, or deficit must be funded, as you see here. So if I have an external forecast, this will help me in order to estimate the relation between the firm sales and the key external economic indicators, either inflation, interest rate, and how the performance is working on. Internally, we need to look for the owner sales of channels. So the cash budget here, if you look for the cash budget here, it starts by the cash recipients, how much of money I received for this operation inside the company, and then I subtract from it the second statement, which is disbursement. So we are going to do the following items as follows. We're going to start by the first statement, number A, which is the cash recipients, and then the second statement, the cash disbursement, number B, and then we will have the net cash flow. So the net cash here, which will be the C, it can give us the second statement, which is the general format, which is I'm going to add over the beginning of cash, and then I'm going to have the ending cash, and then I will add for them the minimum cash balance. So let's say, for example, if I'm starting by saying that I have any cash recipients by 100 and I have a cash disbursement by 50, so the net cash, it will be here, after I subtract all, it will be plus 50. If I have from the previous one beginning of cash, or a cash that I'm going to transfer it to the coming month, then it will be 20. And then we go to have the summation of both of them. So I'm going to add the 50 plus the 20, it will give me the 70. If I receive this 70, and then I'm going to subtract from them the minimum cash for reserves, for emergency, for any unexpected plan. So the 70 minus 30, then it will give me 40. So this is the required total of finance. So it is plus. So if the final answer is you have it, it is plus, then it will be excess of cash, then we have inflow of money. If it is in negative, then this is required to finance that I have to look for a means of loans, extra partner, or anything like that. So let's see for an example how we can do the cash budget and the components of the cash budget, as we're going to see in the previous example, in the coming example, sorry. So we are going to prepare the cash budget for October, November, December, and we never make forecasting without an actual data. So as I'm going to write right now, that you will see that August and September are actual. Okay, and I'm required to do what? I need to forecast for the, what month is? For month 10, 11, and then 12. This is the forecast. Perfect. So he is giving me a given data, the 100K and 200K, which is here the forecasted sales, and or the given data, this is the actual sales. And he told me that the forecasted, according to their estimation, campaigns, targeting plans for increasing the sales, and it will be 400, 300, and 200. So this is the expected. So the first step you need to have the forecasted sales for the coming. What is your plan? And then you are going to tell me if you are going to work on cash base, on credit base. What do you mean by cash base? That means that all the 100 are going to be paid on cash. But if I'm working on a credit base, I'm not paying all the amount of money on directly. So this is what we call it credit base. So here the 100%, this amount of 100, how can I collect it? So the 100, as you see here, I'm going to collect first this 20. I'm going to receive the 20 because the payment term said that you are going to give me 20 in the first month on cash. This is great. And one month later, I'm going to receive the second payments, which is 50% of that, which is what? 50% of the 100. So it is 100, and this 100, I'm going to take out of it 50%. And this is what we mean by the next month, I'm going to receive the 50. Okay. What else were the rest? The rest of the 100, I just received 50, and I just received 20. Then it is left for me what? He said that the last 30% that you are going to receive it 2 months. After 2 months, you are going to receive the last payment, which is the 100 times the 30, and this is will give me 30%, and this is will give me what we see, the 30. So this is basically the payment terms. How can I pay this money? So this 100 I take on cash 20, and then in the next month I take 50, and in the 2 months later I take the 30. I will do the same for all the sales that I'm going to do. So it will be the same for the sales of September. What I will do in September, he said to me that you are going to take also 20%. So 20% out of the 200, it will be $40. And then 1 month later, I will receive 50% of the 200, which is 100. And after 1 month later, I'm going to receive the 30%, which is the 60. So as you see here, this 200 is divided into 3 payments, 3 times. 20% on cash from the 200, and then 50% of the cash. It is 1 month later, and 2 months later, I take the 30. I will do the same for October. In October, I'm going to receive 20% from the 400. So it's just the 20% from the 400 as I did here, which is the policy I'm writing here for you. So 20% from this 400 is 80, and then 50% of the 400, it is 200, and then another 30%, which is what? Which is it is the 30% 1 month later, which is what? Which is the 120. So 30% of the 400, and then 50% of the 400, and then 20% of the 400. Let's go for November, 20% from the 300, and then 50%, and then I'm stopped like right here. 50% of the 300, that is 150. That's all. I'm not in need to prepare for Jane because he's asking for just December. It is the month that I'm prepared. So what about December? Just I will do the 20%. Why? Because he's asking for December and is not asking for Jane. So by this, I can finish, as you see, the what? I finish the receipts or the city receipts that I received from the sales. He also mentioned that he have a dividends from another company, which is representing 30K, and I put the 30K. So since I am estimating, I will care only about the months that I'm estimating, which is October and November and then December. This is what I'm expecting. So I will add what? I will add the following observation, which is the 80 and then the 100 and the 30. Where is the 400? It is the policy that I'm looking for. So 80 plus 100 plus 30, it will give me 210. I will do the same for the last one, sorry. I will do the same for the one after it, which is, I will do this will be the 210. I will do the same for November, 60, 260, and then it is 320, the summation of them. 40, 150, 120, and this is the 30, and this is the 340. So this is basically I'm looking for. This, the one I'm writing here, it is the one I'm looking for. The 200 is the recipient, total cash recipients, and it is number A, as I mentioned. So the cash budget is prepared from 3 components. What are the 3 components? If we go back, this is the cash recipient. So what I did right now, I just did the first part, which is A, which is the cash recipient. What after the cash receipt, if we go back, disbursement, what are the expenses? So after I prepare the cash receipts, I go for the cash disbursement. So the expenses here, what the company spend, how much of balance she have. So this is the policy of the company. As you see here, that the company have a certain policy that you have an end of cash, which is 50, which is the one I'm looking for. And there is no notes payable, market securities is 0. Minimum cash of the company is 25K, and this is the policy of the company. So I need to prepare the second B, and then we'll go for C. So as you see here, I put for you the conditions and the assumptions, the policy that the company use. What the company use? The company is using a policy by saying that she is buying items 70% out of the sales. So it is 70% out of the sales. And then 10% will be paid immediately. And then 70% is paid in the months after that, and 20% in 2 months. So what we will have here, we are going to do the following parts. So what we will have here, we are going to take 70% from the sales. What are the sales? The sales that we have it from the previous, which was 200 here. So this is the purchases. What is my purchases? So I have to write it for you here. So how can I got these purchases? He said that these purchases will represent 70%. So what are the purchases here? I have 200 sales and I will take only 70% of it, which is 140. So this is how can I got the 140, which is my purchase. 140, sorry. It is 100 times 0.7, then it is 70. And I will do the same for each item. The one after it, it is 200, and 200 times 0.7, then 140. So I will take the sales and multiply it by the condition, which is giving here 70%. No one can imagine that I buy the things and I sell it with the same selling price. So it is 70% out of the total sales. So 70, 140, and 280, 210, 140. So this is the calculations for the purchase. How can I pay for these purchases? I'm not paying on cash. In this example, he mentioned that you are going to pay only 10% in the current month, 10% on the current month. So 10% from the 70, then it is $7. And then after 1 month, so what I'm looking for, after 1 month, I have to take 70% out of the $70. So if we can write here, then 1 month later, I have 70 times 0.7, then it will give me the 49, and then I'm going to do all of these things together. Okay, and what about 1 month later? 1 month later, I will have as well what? I will have, as you see here, 1 month later, you will see here, I have to go for the October, and this October, which means 70 times 0.2, 70 times 0.2. So basically it will be the 14 that you see it here. So this is how I prepare the payments. So I buy things by $70, but I didn't pay them, all of them on cash. I pay 10% of the 70, which is $7, and then 50% out of the 70, which is 49, and then 20% out of the 70, which is 14. I will do the same for each one of them as follows. So the 140 here, as you see, the 140, how can I do it? The 140, I will start by 10% out of the 140. So this is the 140, 14%. For 140 out of 10, it is $14. And then I go for, he mentioned what? 70% out of the 140. And then he mentioned what? He mentioned the months after it, you are going to pay 20%. So as you see here, at that this month, I took 70%, and this month I pay the rest, which is 20%. This is the policy we have. I will do the same for 280. I will take 10% of the 280, then it is $28. This is the $28. I pay them on cash on the spot. 1 month later, the policy said that you have to pay 70% of your purchases. And then the months after it, you are going to pay the 20%. As well in November, I take 10% of the 210, and here I pay the 70%, and that's it. I will not prepare anything for Jane because he's not asking except for December. The last month is the easiest one, which is 10%. Okay, so this is basically how we do the purchases for this company in each item of all of these items. So what is left? He mentioned as well that you have wages, you have salaries, you have tax payment, and I need to elaborate it a little bit once more here. So he mean wages, salaries, and taxes, it is given. And he said that you have to pay taxes in December 25, and you buy machines in 130, and you pay any interest, it is 10, and there is a cash dividends 20 in October. And finally, you have a principal payment, which is a loan, which is 20. So as well as we did in the recipients, we're going to do in the disbursement, and the meaning of disbursement is the expenses. So as you see here, I'm going to add what? I'm going to add the 28, the 98, the 14, the 5, the 48, and the 20. These are the givens that we have it here. After we add all of these, then we receive the disbursement. What are the disbursement? How much I spend here, how much I spent in October. And then I go for the months after it. What is the months after it? I will look for 196. I will as well, I will add the 21, sorry, I will add the 21, and after that I'm going to look for, let's say 21 and 196, 28, 5, 38, 38 and 130 here. So all of these things, I'm going to add them to find the disbursement in November, which is 418. And this is the disbursement for December 305. And this is the total cash disbursement. So the total cash disbursement that I receive it here, it's the summations that I'm expecting for the future October, November, and December. So we know from table A, which is the recipient, 210, 320, 340. And we know from this table 213, 418, and 305, I put them as a disbursement subtraction. So what I'm received, this is inflow, and what I spend outflow. So net cash is -3, net cash 98, and plus 35 in December. So he mentioned in the policy, if you go back a little bit for the 2 slides, he said that you have in September, you have 50K in the terms of cash balance, and you have minimum cash 25. So I need to finalize that cash budget for me. So I will add the 50. So I have a shortage of 3, and I receive 550 here. So the end of cash in this month, it is 47. But I have to keep aside $25,000, which is a minimum cash. So when we look for this 25 minus 47, this means it is plus 22, which is excess of cash. I have extra money. I have enough money. If I go for the month after it, which is the end of cash, it will be the beginning. Then I have a shortage of 98, net cash flow 98, and then plus 47, then it is be 51. It is shortage as well. When we look for the minimum cash balance here, I have to keep it. So I have a problem in November because I have to find a required to finance by 76, and then in December as well, the same case. So I add the cash recipient minus disbursement. Net cash is 35 minus 51 with the beginning that I receive it from the previous months. So I have a shortage in this month, despite that I have a high cash receipts, and this will be 41 as well. It is the required to finance. So this means that in November and December, we have to require to finance, look for notes payable, loans, and all these things. Okay, let's go for the pro forma financial statement, which is pro forma income statement. It is an estimating. So I have to prepare it depending on the previous or the preceding years from the sales. So I need to have sales forecast for the coming year. I need to have financial statement of a previous year and put my own assumptions. So we have 3 criteria, very important. I need to have the financial statement of the previous year. I need to have the forecast for the coming year, and I need to have the key assumption about the factor that I'm looking for. So let's see, the generic form of the income statement is the sales and the cost of goods sold overall, and this will give me gross income or gross profit, and then subtracting the operating expenses, the selling expenses, administrations, advertisement, depreciation, research and development, all these things, and this will give me earning before interest and tax, and then we subtracted the interest, and then it will give me earning before tax, EBIT, earning before tax, EBT, and then we subtract the taxes, it will give me net income. So this is simply the income statement. So I give you here an example for a pro forma income statement and how we can prepare it. So this is the previous, and he was asking me to prepare the estimate the year 2021, which is expected to be 3 million. So this is the first assumption that we have just mentioned. We need to have first the previous preceding financial statement, and then the forecast and the assumptions. So if you see here in this slide, you will have the previous financial statement for 2020, and he have the sales, expected sales, and then he said to me that pay attention that you will have that the interest expenses expected to remain unchanged, and the firm plan cash dividends, it is 140 during 2021, and he is asking me to prepare. So in order to prepare pro forma income statement, we said that we need to have the previous year income statement, and we need to have the assumption of the sales, but we depend on point of sales, which means that I have percentage of sales. What are the percent of sales? How much this cost of goods sold represent from the sale? So if I took the COGS, which is 1,820,000, divided 2,800,000, it will give me 65%. And this is the percentage I'm looking for, 65%. So the COGS represents 65% of the sales. If we go for the EBIT, which is as well, how much it is the EBIT? Here, if you go the operating expenses, we can find also the operating expenses, 240 with respect to the 2,800,000. But if we look for the percentage of EBIT, as you see here, which is the 740 operating profit, how much this operating profit is 740, which is represent here 8.57. So it is 240 operating expenses is 240, which is a typo mistake here, 240 divided 2,800,000, then it will be 8.57. So if we look here for the operating expenses, I need to estimate the sales. So the sales is the first item, which is 3 million, and then the COGS, which is 65% out of the 3 million. How can I get this? So in the previous slide, I calculate the 65, and then operating expenses, which is 8.57, which is here 240 divided 2,800,000. So it is 8.57. So the 1,950,000, how can I calculate it? I took the 3 million times 65%, 1,950,000, and then we go for the operating expenses with the 240 million. So how can I get it? So 3 million times 8.75, which will give me 257, 143. So this is the operating expenses. And then we go for the interest, it is given, and then we have to calculate the taxes, which is 7. Took the net profit after tax, after we subtract the COGS, and then giving me the gross profit. We subtract the operating expenses, giving me operating profit. We subtract the interest, and then it gives me net profit before tax. So this net profit before tax, I take it times 40%, which is 289, 143. So it will give me here 289, 143. So I subtracted from the net profit before tax, it gave me net profit after tax. And the dividends here, it is given, no change in it. So it is 140,000. Then it will give me the returned earnings that left for me for this year, 2021. So this is basically the PROFORMA income statement, which depend on the percentage. How can I get the percentage with the 65 and 8.57? And I can do this for every one of these. If he didn't mention interest, how much it is, then I can calculate it with respect to the sales. So I estimating everyone with respect to the sales. Let's go for the last statement, which is the PROFORMA balance sheet. And here it is judgmental, and the balance sheet, we have an actual balance sheet and we have an estimated balance sheet. The actual balance sheet is given here by these items, and it is needed to be forecasted for the coming year. How can I forecast it? So the judgmental means that we have a minimum cash of 6,000. So this is the 6,000, it is the same. I didn't do anything more. Marketable securities will remain at their current level. They are not going to change. So the 4,000, it will be the 4,000, no change. Account receivable will be approximately, which is represent 45 days of the sales. But the sales here, 45 days of sales on average. So 45, I will use the formula of the average collection period. So what is the sales of this year? So the total sales, how much it is, I need to find that sale, giving me the sales, which is 135. Then the time is 45 divided 365, which is using the ASAP. So if you remember, when we do ratio analysis, we have a formula of average collection period, and this average collection period means account receivable divided by average sales. So what are the account receivable? This is the item that I'm going to need to look for it. So in order to find it, he said to me that it is 45 days. And then he said that you have to find this unknown, and this unknown is divided by the average sales. And what is the average sales? 135,000 K divided by 365 0. So if we do cross multiplication, then the account receivable will be 16875. So this is basically the item that we're looking for the account receivable. So what happened if we said the sales, how much, and then I took this sales and then I estimate based on this sales, I can find the average collection period, and then we can calculate the account receivable. So this is for the first item. The second item is the ending inventory remain at 16,000. This is the ending inventory. How much the ending inventory? 4,000 and 12,000, 16,000. This is the total inventory. We have it here. After that, we can calculate the all items, which is the cash, market securities, account receivable, plus the total inventory is 16,000. This is will give me the total current assets. After that, we go for the net fixed assets. What he said that we have a new machines. A new machines, which is 20, will be purchased, and the depreciation is 8. And so to calculate this value, so it's 20 minus 8, then it is 19. And if you calculate the 51 that we received from before, 51, which is the old amount, and then plus the 19, this is will give me the net, let's see here, the net that we are looking for, net fixed assets. How much is the net fixed assets? So the net fixed assets is the 51, then we add the 20, and minus the 8, then it is the 12, then the 20 minus the 8, then it will give me 12, then it will be the total 63, because we are finding the net fixed assets. Okay, so 63. So this is the total for the current assets. So to add the total current assets and the net fixed assets, it will give me 105,875. So this is basically for the current assets and the total fixed assets. And then we go for the liability side. What will be the liability side? He mentioned that you are going to purchase. The purchases will represent 30% of annual sales, and the sales is 135, let's say, for this company. So how can I find it? So the accounts payable here, it was 7, and I need to find the new accounts payable. And if you remember that the accounts payable we were using in the financial ratios, we were using the average payment period, and he said here that the purchases will be for 40,500, and this present the purchases. And we said that when we are calculating this, we need the accounts payable divided by the average purchases. So how can I find this? He said that the average purchases here, it is giving for you by 73 days, and this is the 73 days. So we're just putting the 73 days, and the account payable, it is the unknown, and the average purchases, which is the 400,500 divided by 365, then it is easily to find the X, which is the unknown, which will represent for me 8,300, which is the accounts payable, as you see here. And this is will represent the accounts, sorry, 8,100, which is represent the accounts payable. So this is by using the average payment period and account payable. How can I find it? Average purchases, which is given here that it will be 40,500. Tax payable, he will said as well from the judgmental points or the given point that the tax payable will be changed. Instead of 300, it will become 455. Notes payable will be the same, and the other current liability will be the same. What else is going to be changed? He said nothing is going to be changed anymore. So it's 16,000, 30,000, and then left for me, return earnings will be changed according to the PROFORMA income statement, according to the PROFORMA income statement that we have just calculated from the previous income statement. And that is where we are going to find the PROFORMA balance sheet and the PROFORMA income statement. Wishing you understood everything. Thank you so much, and see you in the next video. Best of success.